Richard, there is a hot debate going on in Silicon Valley right now over companies coming to market through initial public offerings, and some venture capitalists claim this process is rigged. Tell us what's going on.
Well, so the argument is, here are these companies, you have early investors, the VCs, the founders, they're in these companies, they take them public, these investment banks come in, they prepare them to go public, they market them, but they always want to leave in the price, leave some room for their institutional clients to make money. So there's two problems with that some of these VCs like Benchmark Capital's Bill Gurley see. One is the big fees. They charge, let's say, 5 to 6% of the proceeds they're going to raise. So it's quite a big fee, big compared to other parts of the world too. So that's a legitimate complaint in some ways. Second, that because they leave this gap, in the hope that the shares will always pop a little so that new investors can feel good at the end of the day. That actually, I think we talk about that being about 10%, that maybe not that much, but he points to some data that suggests it's actually much more than that. So they're underpriced. So this value gets transferred to these people who've owned the stock for less than 24 hours.
Right, so he's talking about the IPO process as done by companies like Uber or Beyond Meat, but he's also suggesting, isn't he, that companies look at this other way of listing, a direct listing, which is what Spotify did, Slack did. What are the merits of that?
These complaints are not new, and one of the features of a traditional IPO is it raises money. Now, if you don't need to raise money, you can just list your shares and say, right, I'm going to list on the New York Stock Exchange. The stock exchange has to accept you, and you have to file a prospectus and stuff because you're going to be a public traded stock, but it's a less intensive marketing process. The banks are involved, but they don't have to find investors, so it's cheaper. And the idea is, here we are, existing investors, we list the stock, it finds its correct level in the market, and then nobody is super gained or super lost as a result of that on a quick in. There's no quick hit, no quick flips that people can do. And then after that, we can decide what we want to do.
So if looking globally at stock issuance, we had some data out earlier this week that said that global issues were down about a fifth year on year. And hanging over all of this is the spirit of WeWork, which of course pulled its IPO last week. Valuation had collapsed. So has all of this stuff, have companies like WeWork trying to come to market and failing, has that irreparably damaged the whole IPO process, do you think?
Well, I think this is a really interesting question, especially right now. So these VCs are having this meeting today to sort of tell startups there's this other option, direct listing. You wonder if they've all kind of missed the boat for floating in the market, and WeWork has been part of that. And this is the flip side of the venture capitalists are investors. They are the people who've kept WeWork going this long, and yet it came to market with no obvious way to make money, huge losses, huge cash needs, terrible governance. That does far more damage to the credibility of these companies than the IPO process.
So maybe the VC should be looking a bit closer to home before they start blaming the process.
I think you could say that.
Well, thanks very much, Richard, and join us here tomorrow for more Breaking Views.